Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell and the broad market sell-off gaining steam from stocks to metals to crypto. Our very own Jared Blikre is here to break down all the action. Jared.
That's right, Josh. Pretty broad selling, except in bonds. We'll take a look at that in a second. Let's go over the stock market first. Dow down almost 500 points, or about 1%. Certainly not a disaster, and we're only a few percentage points away from record highs here. The real carnage is in crypto, and we will touch on that in a second. But here's the Dow. You can see it spent the whole day in red territory there, and we were somewhat close to the lows of the day. Again, down 1%. NASDAQ composite down a little bit more than that. Very similar chart. In the S&P 500, also down about 1%. I'll show you the small caps as well, which were leading most of January and have just kind of fallen off a little bit over the last few days, down 1.42% today for the Russell 2000. And I want to get to the bond market here as promised. Here's the 10-year T-note yield. It is down 7 basis points to 4.21%. That is a pretty large amount. And when yields are going down, that means bond prices are getting up. So people are buying bonds, and there is that flight to safety trade going on right now. Here's the 30-year. It's down 6 basis points to 4.86%. And the U.S. dollar index, meanwhile, is a little bit bid here. So it's certainly not sell America by any stretch. It's sell stocks and commodities to a certain extent. So let's get to some sector action, and then we'll check out some of the indices and then Bitcoin. Here you can see in the large cap sectors for the S&P 500, everything in the red. The staples sector actually hit an intraday record high on the open, but you can see it's now down about 0.8%. And actually, let me there we go. That's the right view. Utilities in the green there. Staples is number 2. And XLB Materials, that is down 2%. That is the worst off of the group. Also looking at some pretty big declines in consumer discretionary. That's XLY, XLK, and XLF. So that's tech and financials to round out those terms there. Here's the NASDAQ 100, and you can see Microsoft down 4%. The sell-off in software continues. Amazon down 4.5%. And let's just dive into software right now, where we can see a couple green spots like Cisco and IBM, but for the most part, a lot of dark red there. And in semiconductors, well, that is the opposite story, a bastion of strength, if you will. But I did promise crypto, and I do want to get to that. Here we have Bitcoin down 11, almost 12% over the trailing 24 hours. And then you take a look at some of the other coins like Ripple down 21%, Solana down 13%. Let me give you a number for that, 65,000. The record high was 125,000 in October of last year. So Bitcoin is in danger of nearly being cut in half. Here's a one-year chart, and that is a real ouch. Very oversold on the daily, the weekly, and the monthly. We'll have to see if we get a little dead cat bounce, but at this point, looking like that crypto winter has arrived, Josh.
All right, Jared, thank you. Well, the sell-off building as the NASDAQ extends its rout to a third day in a row. Gina Martin-Adams, HB Wealth, Chief Market Strategist, joining us to discuss. Gina, let's start here. You say so far in 2026, you say almost everything is beating tech. Yeah. Of course, you're right, of course, this year what's been working, it's energy, it's materials. Yeah. So do you look at that rotation, Gina, and you say, okay, this is real, it's sustainable, it's durable, or no, it's more of it's going to prove to be kind of a short-term trade?
Right.
What do you think?
I think it's incredibly unlikely that everything wins except for tech. I think instead, over the course of 2026, we probably see a little bit more discernment between winners and losers. We start to see things like in the earnings season, one of the things that we looked for in earnings was financials, looked a little ahead of its skis. We were overconfident in terms of financials valuations back well beyond multi-year highs. We're indicating that maybe financials were a bit overpriced. Financials has become a little bit of a weak player. Likewise, it's very unlikely that you see energy and material stocks perform well and consumer stocks perform well in the same time period, because usually when energy and material stocks are performing well, it's because costs are increasing, commodity prices are increasing, and that tends to be something of a depressant on the consumer
That was an
sectors.
interesting thing I thought in your notes, and just elaborate, because that was an interesting trend.
Yeah.
You talked about this sort of commodities versus consumer.
Yeah, it's almost inevitable that it's either or. It's very rare that you see the consumer rallying and performing very well. For instance, when oil prices are elevated, they spend more at the pump, therefore they have less to spend on discretionary items, right? So it's very simplistic, but nonetheless, it's in the cycle, you generally either see commodities leadership or you could see consumer leadership. The one sector that kind of rides in the middle that I think nobody's really talking about is in industrials. And industrials indeed are sitting at very elevated valuations, but they are beneficiaries of rising commodity costs to some degree. They're also beneficiaries of tax reform in that any company that is going to spend on long-dated investment gets to immediately expense that investment over the course of this year and next and into perpetuity now. That is a big benefit to the industrials companies that are dependent upon that long-dated spending. So industrials tend to, I think there's a reason why industrials have performed so well and have kind of fallen beneath the radar, if you will. They're breaking out higher, at least until the last couple of days of market weakness. That industrial sector is also a big part of the small cap space. It tends to get ignored somewhat in the large cap index, but it's a sector that has done reasonably well in small caps too. And then the other thing that I would say about industrials, where it's just kind of flying beneath the radar, is it's defense spending. When you have this multi-decade potential reset in defense spending, given geopolitical risks globally, industrials may be a pretty big beneficiary of that. So that's the one segment that I'm watching really carefully is maybe this is the one that endures, but otherwise it's either an inflation trade or a consumer trade. You've kind of got to pick one or the other.
Yep. Let me ask you, on staples, some folks were sort of looking at people moving into staples, and I heard some investors saying, to them, because that's defensive, the fact that people were moving there, they sort of saw that, Gina, as kind of like a yellow flag.
Yep.
I was just wondering if that's how you see it.
It is. Staples do not outperform in an up market. It's just it's one of the just golden rules of the S&P 500 is if you're overweight staples, then you're inherently suggesting some degree of defensive bias. Staples do very well in a down market or in a weak market because they're a low beta sector. Utilities used to have this status. Utilities has become very interesting because unlike staples, utilities has become a derivative play on AI. Utilities
so
has been the recipient of tech, and it's a little bit more offensive. Still low beta, but I think that element of the tech tie has sort of weighed on utilities a bit more, at least recently. But staples is more of a pure play defensive strategy. Now you have days like today where staples, you have earnings that have been somewhat disappointing from Estee Lauder, for example, and that may weigh a little bit on the staples sector, but generally they don't even need earnings. In an environment where stocks are selling off, staples as a low beta play tend to perform pretty well.
Interested to just get your broad take on mega cap tech.
Yeah.
The earnings, also just the divergent reactions have been interesting.
Yep.
So investors, they like what they heard from Mark Zuckerberg at Meta. He gets rewarded. Microsoft and Alphabet, not so much.
Right.
We got Amazon after the bell today. What do you make of it?
Some of it is just what was embedded in expectations. I think that's a really important. The setup for each of these companies coming into earnings season is always a key component of the stock price reaction after earnings. Nonetheless, two really big themes kind of have emerged in big cap tech, and that is, how much are you spending on CapEx, and how much is that going to deplete your margin outlook in an environment where you still have relatively strong revenue growth, but how much revenue growth are you getting? And that's where Microsoft fell short. I think that's what the market is a little bit nervous about with respect to Amazon, is cloud has become a really big part of the revenue line, has been a really big part of the theme, sort of the thematic driver of why you invest in these entities. And Microsoft disappointed the market in terms of cloud revenue. That may happen with Amazon. I think that's why you see this weakness coming for Amazon. There's a little bit of nervousness there. So that's the revenue side. And then the CapEx side is really clear. We saw that with Alphabet, certainly. We may see that across more companies throughout the tech sector, is how much investment do you need to have?
I did a double take on that
long-term margin?
That CapEx forecast, as much as $185 billion, I thought I read it wrong at first.
Right.
I mean, it's hard to get your head around these kind of numbers.
It is, and remember, this is what really started to dismantle the tech trade last fall, is the capital spending idea. And now we've got capital spending as a core issue, combined with revenue growth as a core issue, combined with AI implementation, taking out the potential growth rates for some of the weaker players inside the space as well. So there's multiple channels that are hitting tech all at the same time. Broadly, that's a reflection of the fact that tech valuations, frankly, just flew too close to the sun. You very rarely get to a point where multiples for tech are commanding a 40% premium to the market. As a matter of fact, over the long haul, in the middle of a cycle, tech stocks command zero premium relative to the market. But we commanded a premium of 40%. That's something you only saw back in the tech bubble. It does suggest that there is some speculative excess likely that has become embedded in these stocks as, frankly, they've beaten expectations, constantly raised those expectations, and then that creates this higher and higher expectation embedded in stock prices. It's almost impossible for the companies to satisfy that no matter how well they do. And so the market starts picking away at these small weaknesses, and I think that's what we're seeing today.
I want to get you out of here on this, on a comment you made about the Fed, Gina. You say, even without more rate cuts, the Fed is still easy. Yeah. In plain English, explain what you mean by that, and then what that means for stocks and bonds.
Yeah, so if you just look at the status of Fed policy, where should it be? One way to think about that is to utilize the Taylor rule, which really just takes pure economic conditions between growth and inflation and says, what is a reasonable expectation for the Fed funds rate? You compare that to the Fed funds rate over time. Over long periods of history, we've averaged a Fed funds rate that's about 1.5 percentage points below the Taylor rule. Currently, we're 2 percentage points below the Taylor rule on the Fed funds rate. So in theory, that would mean that we are easy relative to long-term history based on the run rate of economic conditions and inflationary pressures. The Fed is in a state of easy relative to the long-term trends. What does that mean for stocks? Practically, it usually means over the long run, you get a slightly better rate of return on stocks over a 12-month period. When the Fed is easy, you get an average annualized return of about 8%. When the Fed is tight, in the opposite position, where the Fed funds rate is above the Taylor rule, you tend to have much lower returns. Your average long-term return is closer to 4%. So just from a status of monetary policy, it's helpful to keep in mind in the back of your head that liquidity conditions are still pretty supportive. The Fed is still on the side, operating on the side of the market, probably going to ease if the president has his way, and if Warsh fulfills his stated objectives. We may see another easing as early as June, according to the market, and that usually is pretty helpful to the equity market. Right now, we're in a reset, certainly, because we've become a little bit excessive in terms of expectations and speculation, in particular with respect to tech, and earnings are really struggling to satisfy those expectations. But longer run, it's important to keep in mind that monetary support is still there.
Gina, so great to see you, especially on set. Thank you for your help today.
Thank you. Thank you for having me.
Coming up, one of the key drivers of the losses on Wall Street, Qualcomm, company's CFO, joins me next to further explain that soft guidance. We're watching shares of Qualcomm here. That stock under pressure as the chip giant raised concerns about memory, which dented its outlook. Joining me now, we got Akash Palkhiwala, Qualcomm CFO and COO, along with Yahoo Finance tech editor Dan Howley. Akash, it is good to see you. So let's dig into this. You beat on revenue and earnings for the quarter, Akash. Your guidance misses consensus, and it sounds like the issue here, it's memory tightness impacting handset builds. Just walk me through what you're seeing, Akash, and how long do you think those memory constraints persist, Akash? You know, is it a quarter, two, longer?
Of course. Well, great to see you, first of all. Thanks for having me. We had an incredible results for the first quarter. We had record revenues, record earnings per share, and then within our chipset business, we had record for handset revenues and record for automotive revenues. So very happy to the quarter that we reported. When you think about the following quarter, which is the guidance quarter, we gave very strong guidance in automotive and IoT, automotive growing greater than 35% on a year-over-year basis, and IoT growing in low teens. The challenge that we outlined is really for the handset business, where the demand continues to be strong. We saw consumers continuing to buy handsets as we had expected. Our design win pipeline within chips is very strong as well, and the economic backdrop is reasonable as well. So when you put those three together, the demand profile in handsets has not changed. What has really changed is our customers' access to memory and pricing. given the success of data centers and several of the memory vendors redirecting some of their supply to the data center needs, the handset customers are constrained. And what you're seeing being reflected in our outlook is really the adjustment process that the customers are going through. And we see it as a short-term phenomena that'll get settled over some period of time. There are a lot of uncertainties at this point, so difficult to pinpoint the timeline, but it is a short-term phenomena that'll get settled. I think the demand is very important for us. It's stable. And as we look forward, we're confident that we'll be able to tide this and continue kind of on the trajectory our handset business was on before this started.
Akash, it's Dan here. Good to see you. I wanted to just kind of ask about where the kind of landscape is as far as the different types of handsets that are being impacted, right? Because, you guys aren't the only ones that are being impacted by memory, obviously. We had Apple discuss that. We had different PC makers are kind of, dealing with this as well. It's not just, smartphones, laptops, it's anything kind of that uses this kind of memory. Where are you seeing this, though, as far as the price point? Like, is it the lower end handsets? Is it the higher end? Is it, where does that sit? And then I want to ask, about the data center business that you guys have. That's in early innings still. Does it play into that at all, or is that just on a separate note?
Yeah, so these are great questions, Dan. And when you think about the handset market, if you're a handset OEM, a lot of your margin and profit is made in the high tiers. That is where Qualcomm is very strong. And so as the OEMs kind of work through the constraints, we very much expect them to be able to fulfill the needs they have over the premium and high tiers. And that should help us a lot because that's, again, as I said before, that's where Qualcomm is very strong. You might see a little bit of volume being sacrificed at the mid-low tiers where there might not be enough supply. And so there's a little bit of impact on us. But I think the key focus for us is focusing on the high tier where Qualcomm is very strong. Data center is an area that we're extremely excited about. As you know, we're not a material player in that business today. But as the data center is changing, inference is becoming more important, power efficiency is becoming more important. We are able to bring the technologies that we have created on the edge and create something unique for us. So we've come up with these new chips. We call it AI 200 and AI 250 that come this year and next year. And what they will be able to do is deliver inference performance that's best in class at very, very low power. And then we're also addressing with AI 250 memory bandwidth, which is one of the constraints that data center operators have. And so as we come in with these unique chips that give an advantage to our customers, we're very optimistic about the traction that we'll get around it. And we're looking forward to our investor day in a few months where we'll provide a lot more details about the product and the traction and the customer interest.
Akash, let's talk margins here for a second because chip gross margins, analysts were saying this morning, Akash, they seem fine, they said. And so I'm just walk me through the puts and takes there. Is that mix improvement, Akash? Is it cost advantages? What's going on? And what do you see ahead? What does the trajectory of those margins look like, Akash?
Yeah, Josh, our gross margins have been very strong. And the reason for that is technology leadership. I mean, we've done very well. We have very unique industry-leading products. Our customers recognize that, and that's reflected in our gross margin profile. As we go forward, I think that's going to continue. Our leadership is going to stay intact. We are introducing new chips that really offer these unique capabilities, not just in processing, but in AI. We see that as we look at 2027, you're going to see new experiences come into phones, especially with agentic AI at the center of it. And our roadmap gets stronger, and I think that's going to continue to get reflected in our gross margins.
As far as the automotive business goes, you guys have been a player in this for quite some time, and it seems to be on the up and up for the past few quarters. Where do you see that going at this point? How do you expect that to continue to evolve? And I got to ask again, is memory an issue at all in that aspect?
Yeah, I think we've been very excited about our automotive business. I think we've taken the technology portfolio that we have in handsets and really kind of added significant capability to it to make it optimized and suitable for where the cars are going, right? That is an industry that's in transition. It requires a lot more and different kind of technologies than it did a few years ago. And Qualcomm is hitting that inflection point and bringing the right set of technologies into cars. So very excited. I think we talked about Volkswagen signing up with Qualcomm at scale Several Japanese OEMs, Korean OEMs, US OEMs, Chinese, Europeans, they're all using our technology. And so the scale that we bring to bear is incredible. And we're now becoming the leader in ADAS as well going forward, autonomous driving. The other thing I'll say about automotive is that we are able to leverage this technology into robotics as well. Robotics obviously is an incredible new area that's coming up with humanoids and manufacturing robots and warehousing robots. All kinds of changes happening in the industry, and this is going to be a massive market. And Qualcomm is now at the center of that transformation with our new product, Dragonwing IQ10, which brings the strengths from a connectivity, processing, and AI perspective all together and really optimized product for robotics and humanoids going forward. So very excited about working with the industry leaders on it. And as you look forward for Qualcomm, I think the opportunities are really limitless.
Yeah, I got to mess around with some of the robots at CES last month, which feels like it was 10 years ago, considering how wild this past week has been. But I just want to ask, lastly, on IoT. You guys have a strong business there. I got to see one of those cool interactive bird feeders at CES as well. Fortunately, I can't put that into my apartment. But where do you guys see that business kind of taking shape, and where is the biggest growth opportunity there for you guys?
Yeah, I'll highlight personally AI devices as something that's really a transformation of the consumer experience. I think we've had wearable devices for a while, whether you're putting it on your wrist or in your ears. But those devices are being transformed, and glasses are being added to those device list. And think of a device that can see everything you can see, a device that can hear everything you can hear, and a device that has an AI agent and you can have a conversation with it. And it becomes the most personal device to you. It becomes a device that understands everything about you, can anticipate your needs and help you. And that's a transformation that's coming globally. We're working with the leaders in US, we're working with leaders in China, in India, and other geographies. And that's going to be a massive transformation, a new device coming into the consumer ecosystem, and Qualcomm's at the center of that transformation. So very excited about that part of the IoT business.
All right, thank you, Akash and Dan. Appreciate it.
Thanks very much, guys. Appreciate it.
Agricultural equipment manufacturer AGCO reporting better than expected earnings and revenue in the fourth quarter. The latest results come as the farm economy faces income pressure and global trade dynamics. Here to discuss is AGCO CEO Eric Hansotia, along with Yahoo Finance's Julie Hyman. Eric, it is great to see you. Let's dig into these results, Eric, because analysts were noting, hey, you delivered, they say, strong top and bottom line beats to finish 2025, but your margin guide, they say, Eric, that did come in a bit light versus consensus. Help me understand what's going on there, Eric. Is it mix, cost inflation? Is it investment? Give me the puts and takes.
Yeah, well, we closed 2025 at so many records. We had record free cash flow, record market share. We gained the most share in North America we've ever had in the history of the company, record customer satisfaction, record safety for our employees. So it was a really strong close to the year in an environment that was super difficult for our farmers. So we feel really good about execution on the things we can control. Now let's look into 26 to touch the other half of your question. The tariffs really didn't show up until the back part of 2025 in terms of the cost impact. We'll see more cost impact in 2026 to the tune of about $100 million. So that's a bit of a headwind for us going into next year. Also, the North America market, which is not our biggest market, but the North America market is going to be down another 15%. Now, this market's been battered in that it's last year in 2025, there's fewer tractors bought than any year since prior to World War II, and it's going to go down another 15%. The age of the fleet is as old as it's been in a lot of recorded times. So the market's tough with the extra cost pressure that we've got. That's a bit of the situation that we've got going on. We're just trying to control the things we can control and manage through this.
Hey, Eric, it's Julie here. So as you mentioned, the backdrop has been tough here, particularly in North America. You did say on the call that 2025 is the bottom of the trough. Were you talking about then the sort of global agricultural economy?
Yes, exactly. So North America will go down, but that's only about 20% of our sales. A little over 60% of our sales is Europe, and we expect that market to be up. And then South America is kind of in the middle. I was just down in South America visiting with many farmers. The smallest farm I was on was 100,000 acres. And they're actually more positive than I expected. European show, we were at the biggest farm show in the world. just a couple months ago. Also positive sentiment there. And once again, the age of the fleet is quite old. And with our new AI technologies on our machines, our new data platform, the innovation we've been driving, 14 new launches this year, all of that is creating thirst and pull into a market that's got some pent-up demand because of the age of the fleet.
Eric, I thought an interesting point you made here is you said you gained global market share in 25, including, you say, largest ever gains in North America large ag. I'm curious, Eric, what drove that? Why are farmers choosing you, Eric, over the competition? And how sustainable do you think that is?
Very sustainable. So there's two main reasons. We've been bringing in a new brand into North America that's performing at the very top of the market, the premium segment, the most demanding customers that want the best of the best. That brand is called Fendt. And until about 5 years ago, we really had it predominantly in Europe. But now we're bringing it to North America and South America. And those customers that try Fendt, there's a picture of the Fendt tractor on your screen. Those customers that try a Fendt tractor or planter recognize it is just the best product in the marketplace. And then we've been wrapping it with a dealer experience, a support experience that's also second to none. We have what we call a Gold Star program that takes care of everything for 3 years, maintenance, all the repairs. If there's a machine is down, we bring in a loaner. So it's a extreme premium experience that customers really love once they are able to operate it. That's number one. Then number two is our technology. We have a very unique business. We call it PTX, Precision Technologies Multiplied. It's a $2.3 billion acquisition we made last year as a big foundation element to form it. And we brought a number of businesses together that we acquired and some that we had built. And that business is retrofit technology. You can see some of that on the screen to increase the capability, automate an existing machine. Now, the other cool thing is we do that on all brands of equipment. So we'll put it on our competitive brands of machinery, could be 5 years old, 8 years old, and give it new life, bring it up to the latest and greatest technology, automating a complicated task on the field. So this combination of Fendt and our technology business are both adding a lot of value to farmers in a new way, and that's why we believe it's so sustainable.
Eric, understanding that you sort of have this tech proposition, which I know is also, it requires an investment on the part of farmers, and recognizing that they've got an aging fleet. I want to bring up a letter that you're probably familiar with that was recently signed by 27 former heads of various farm groups, former agricultural department officials, and they really sounded the alarm about the effect of the trade war on farmers. Among other things, they said farmer bankruptcies have doubled, barely half of all farms will be profitable this year, and the U.S. is running a historic agriculture trade deficit. These metrics reflect a sharp reversal from record farm export surpluses and farm incomes experienced just a few years ago. Now, this speaks to the weakness, that persistent weakness here in North America. I guess the question is there any, you're seeing things trough globally. Is there any light at the end of the tunnel here? Are you confident that the Chinese are going to come back into the market and buy soybeans in size in the coming year or coming couple of years? Is there help coming for those farmers?
Yeah. So not in the short term, but I am confident and bullish in the midterm. And so you listed one of the issues, and that is the demand side of the equation. For farmers, a large part of the grain crop. Now, livestock and dairy, predominantly livestock, they've been doing well. Beef prices are high and so on. So that segment is profitable and continuing to grow. It's really the grain farmer that's been challenged, and that's largely been hit by, or it's been added to, the issue's been added to because of the trade discussions. So China tried to use their buying power of the American grain as a lever in the negotiations, and they stopped buying from the U.S. farmer during 2025. That dropped the prices of grain for the U.S. farmer and gave them a lot of uncertainty. Now, in the past few months, two things have happened. One is China has committed to renewing their grain purchases, and they've been living up to that commitment. They've bought the amount that they committed to in the first tranche. And then secondly, a government subsidy program to help offset some of the impact that trade uncertainty created for the farmer. That went from a plan to now moving into implementation mode. Those are both certainties and a little bit of backstopping on the pricing for grain. It's still too low. Farmers are still not making a good enough profit. And so I think that it is appropriate to sound the alarm in terms of concern for the farmer. What we're doing is trying to do the things that we can control and help control for the farmer. And that is like this retrofit opportunity helps the farmer get the latest and greatest technology at a much lower cost point than buying a whole new machine. We're providing data platforms that they can use in the mixed fleet, so they can take data off of all their competitive machines or our brands and analyze all that data together. We're providing a lot of AI solutions to help solve problems in the service situation faster, help our salespeople sell faster. My point is using technology to make the farmer more productive, more profitable, given this tough backdrop until it clears up. Once it clears up, then these all just also are benefits. So they're good in tough times and required. They'll be really good when the market comes back.
Eric, great to have you on the show today, as well as Julie. Thanks so much for your time.
Thank you to both of you.
Coming up, it's a big week for IPOs on Wall Street. Bob's Discount Furniture is making its debut today. The CEO, straight ahead. It's a busy week on the IPO calendar, and the marquee name today, Bob's Discount Furniture. Let's get to executive editor Brian Sosny on the floor of the New York Stock Exchange with the CEO of Bob's Discount Furniture, Bill Barton. Sosny.
All right, thanks so much, Josh. I can't tell you how refreshing it is to be on the New York Stock Exchange and not talk about a tech IPO. We're just talking furniture. Bill, good to see you. And you're not Bob.
No, I'm definitely not Bob, and it's great to be with you today, Brian.
I'm waiting for one of these Bob holograms, like the commercials will pop out somewhere.
Well, we can make that happen.
All right. So like I mentioned at the top there, I get your company. I very much understood the prospectus. Sales look good, profits look good. What should investors need to know about your company?
Well, what they should know is, first off, for 35 years, we've been helping people turn the place they live into the home they love by doing it the Bob's way. We're very unique. We're much more like a value retailer than your typical furniture retailer, right? Everyday low prices on quality, stylish furniture, and available when you want it. It's available now. So today we have over 200 stores, which sounds like a lot. We have a plan to get to over 500.
When will you hit 500, and where else do you see yourself expanding?
Yeah, it's a great question. So look, our 500 store target is 2035. We have about 300 stores to go. About a third of those will be infill in our existing regions, which is the Northeast, the Midwest, and the West. About a third will be in our newest region in the Southeast. We opened North Carolina this last year.
How's that doing?
It's doing really well, really well. And in large part because we take time to study a market and plan our entry. So we don't presume that, for example, the ads that work in the Northeast work in the Southeast. So we take 2 years to study the market, the consumer demos, the kind of furniture is being bought there, and then our brand awareness. Right up here, you guys all know the brand. Down there, not so much. Right, so we put together a marketing plan to introduce our brand, and it's working quite well.
About a year ago, I went out. I went shopping for a lot of furniture. I went to my local furniture places. Hard sell, guys. Everywhere I went, everybody tried to pressure me into buying a recliner. I ended up going to Bob's. My whole house is retrofitted with Bob's furniture because you guys left me the hell alone. Is that part of how you do business?
Absolutely, and that goes back to our founding, right? Bob Kaufman and his co-founders felt that the whole furniture shopping experience in the other companies was kind of awful. This high pressure, high-low sales thing. You leave those stores, you'd never have any idea whether you got good value. So he said, how about we do it differently? Why don't we try this? A low pressure, fun environment, tell people the truth. So we've always been everyday low price. We've never had a sale in 35 years. And our staff is trained to be helpful and responsive, but no pressure. And what you experience is what we intend to have happen at every one of our stores every day.
Wait, that 60% off discount I got, that wasn't normal, or was that? No, I'm just kidding. I'm talking, Bill.
Well, but what you did get was what we call the Bob's discount. We negotiate great prices. We buy narrow and deep, right? So we make large buys and we pass that on to you.
So I'm going through the prospectus. What have you seen with the consumer this year? I mean, sales look to be good, and most importantly, you have been growing profits greater than sales in a year where costs of things have just gone through the roof, no pun intended.
Yeah, well, for sure. And last year was, of course, a challenging year with tariffs. But, you know, a couple of things. First off, we don't sell any third-party brands. Everything we sell is made for us. We have deep, long-standing relationships with our manufacturing partners. And so through those relationships, we were able to renegotiate costs, to get costs down to offset a lot of the tariffs. There's actually 3 ways we went off after tariff mitigation. Number 1 was asking for cost concessions. We got a lot of them. Number 2, because everything's made for us, we can move venues, right? So we can move between countries or factories to reduce costs. And third, if we have to, and it's always the last thing for us, is take price.
You must have saw my notes because I was scrolling down that prospectus, guys, and you moved out of China?
We did, 2018.
What made the team make that decision? Is that how you've been able to navigate this environment without jacking up prices and trying to just price gouge consumers like a lot of your competitors do?
Yeah, absolutely. Well, after the 2018-2019 tariffs, we moved completely out of China. We moved a lot to Vietnam, some to Malaysia, Cambodia, Thailand, some of it back to the U.S.
How'd you do the U.S.?
Well, all of our mattresses are made here in the U.S. A lot of our upholstery is made here in the U.S. And again, the manufacturers love working with Bob's because as an everyday low-price player, we don't have the spikiness in our sales that our competitors do, which means that our orders to the factories are very consistent. And if you know anything about factories, they love consistent orders. So these great relationships, and we're going to continue to move more back to the U.S. as we can find that capacity.
I'm going to refrain in the minute that I have left from asking a very geeky question on profit margins or cash flow. Who is Bob's? And why I've been watching a Bob's character pop up on my TV screen almost every day for the past 5 years of my life. Who is Bob?
Who is Bob? Bob Kaufman, our original founder. So he started this business with his co-founders 35 years ago. Today, he's still involved in the business in a philanthropic work. And he's like the spiritual leader, right? He's the one that said, the Bob's way is the way we do business. And what you experience is exactly the Bob's way. Low pressure, fun environment, on quality, low price, everyday low price products. Bob is our spiritual leader. He's the one that created this model, and 35 years later, we're still following that model.
Well, congratulations on your IPO. Well received. Keep that furniture coming, and you'll probably see me in the store very soon. Farmingdale, New York. That's where I got my stuff. I'm sure I'll be back there very soon picking up some more.
Love to see you, Brian. Thank you.
All right, appreciate it. Josh, back to you. Go get some furniture, dude.
All right, thank you, Sazi. Now time for some of today's trending tickers. We're going to start here with Peloton. Those shares sinking after reporting second quarter earnings results. Company missing revenue estimates but topping expectations for adjusted EBITDA. Firm also saying CFO Liz Coddington will leave to pursue an opportunity outside the industry. Coddington will remain at Peloton through March, and the company says it has initiated a search for its next CFO. Next up, Tapestry stock shooting higher after upbeat guidance. The owner of Coach and Kate Spade lifting its earnings outlook, topping expectations. As for the second quarter, company reporting net sales and earnings that came above analyst estimates. Guggenheim highlighting impressive upside in gross margins. Tapestry also revealing that it now expects to buy back about $1.2 billion in common stock in fiscal 2026. On the flip side, though, Ralph Lauren under pressure following its quarter results. Company topping third quarter earnings estimates, but expects fourth quarter operating and gross margins to decline due to higher tariffs and marketing investments. And the company remaining upbeat as it lifts its full year sales guidance, seeing growth of high single to low double digits. Well, coming up, another tense day on Capitol Hill for Treasury Secretary Scott Bessent, and the focus squarely on the future of the Fed. The latest, that's straight ahead. Treasury Secretary Scott Bessent back on Capitol Hill facing the Senate Banking Committee, where the focus quickly went to Fed Chair Jerome Powell. Jennifer Schomburg is here with the latest. Jen.
Hey there, Josh. That's right. In a hearing with Treasury Secretary Scott Bessent that was supposed to focus on oversight of the Financial Stability Oversight Council, Republican Senator Thom Tillis used the forum to defend Fed Chair Jay Powell against the Justice Department's criminal investigation into him. Tillis, who has vowed to block President Trump's nomination of Kevin Warsh to be the next chair of the central bank until that criminal investigation is resolved, cited a quote-unquote list of members in the Senate who he said did not find criminal intent in Powell's testimony before this very committee last summer. Take a listen.
The entire case against Senator Powell is encapsulated in his answers to questions before this committee. And now, including the chair, we have witnesses at the alleged scene of the crime we're disappointed with Chair Powell. I actually like Warsh as a potential chair, but we've all said that he was testifying and we didn't see a crime.
Senate Banking Committee Chair Tim Scott on Wednesday said he too does not believe that Powell committed a crime in his testimony. Meanwhile, on the other side of the aisle, Senator Elizabeth Warren, who is the ranking member of the Senate Banking Committee, referencing comments that Trump made over the weekend, asked Secretary Bessent whether, if Warsh did not follow the direction of the president, that he would not sue Warsh. Take a listen.
Can you commit right here and now that Trump's Fed nominee, Kevin Warsh, will not be sued, will not be investigated by the Department of Justice if he doesn't cut interest rates exactly the way that Donald Trump wants?
That is up to the president. Can you commit that you will?
I'm sorry.
Can you commit that you will not hold
up? He won't be sued if he doesn't drop interest rates.
And
he won't be criminally investigated.
The president also made a big joke about you that I won't.
Separately, Bessent was asked whether he supports the 10% cap on credit card interest rates that the president has put forth. Bessent implied that he does and thinks that there is a way for banks to stay profitable if that was put in place for a year. He was also asked about the market structure bill that is going through the Senate right now as it relates to crypto, and said that any company that does not support this bill can move to El Salvador. Josh?
Jen, great stuff as always. Thank you. SpaceX is already thinking about inclusion in major stock indexes ahead of its potential IPO, according to Wall Street Journal. Yahoo Finance's Jared Blikre is here to take a closer look at how companies actually earn a spot in those major indexes in the latest edition of Stocks in Translation.
We've got 3 mega IPOs on deck this year, and now Elon Musk's SpaceX story has a new twist. Its IPO advisors are reportedly looking into getting the space giant into the major indexes like the NASDAQ and S&P 500 a little sooner than usual, which would in turn virtually guarantee billions in stock purchases after the IPO. But it's not a straight shot to get there, and that's what we're digging into in today's Stocks in Translation. First, let's walk through the rules because they really explain the entire game. So here we have both the NASDAQ 100 and the S&P 500 rules, the two index kahunas, and they have two very different philosophies. The NAS 100 is more like a checklist. You list, you trade, you check the boxes, and if you're big enough, you can get in relatively quickly. Right now, you just wait 3 full months. The S&P 500 is more like a country club membership with a credit check. It's not just are you big, it's are you profitable, and does a committee want you in the club, and there's a 1-year minimum wait. And the buzz around it is loud right now because there's also a new idea floating around NASDAQ land, and it's a fast track that could shrink the post-IPO wait time down to 3 weeks. But on the S&P side, there's no discussion of fast tracks just yet, and profitability, it's a hard gate. So fortunately for SpaceX, it will likely pass the 1-year profit test right out of the gate. But for the other 2 mega IPOs, OpenAI and Anthropic, they're almost certainly unprofitable, so they're likely a long way off from joining America's benchmark index. Now let's put some history on this. Here are some examples of big IPOs and how long they had to wait to join the S&P 500. Take Meta, then Facebook, and Alphabet. They both got in fast, about 1 year and 7 months. That's the clean version of the story. Big, liquid, established businesses, and the market got comfortable. Airbnb took longer, almost 3 years. Uber took longer still, over 4 years. Why is this? Because sometimes a company is huge, but the path to consistent profit, that's what matters for the S&P. Palantir is a good reminder that this isn't only an IPO story, that was a direct listing. And it still took almost 4 years to land in the S&P 500. And then there's Tesla, Elon's first big public company. 10 years, 6 months. That one tells you that the S&P is not just about those day one IPO pops. It can be a really long game. Okay, so why do indexes build in a weight at all? First, price discovery. An IPO is a hype machine and a pricing exercise both at the same time. The index wants to see where the stock really lives when all the confetti clears. And second, a new listing has a thin float early on. A lot of shares are still locked up and can't be sold. So a little buying or selling, that can whipsaw the price more than usual. And third, these lockups change the supply of shares. And this is where you can get a sneaky price drop when the lockup expires, even if the IPO looked great on day one. And finally, index additions can distort, because when an index adds a stock, some funds have to buy it. Not because they love it, because their job is to match the index. And here's a great reality check from the definitive IPO trading book called The Life Cycle Trade. Kathleen Donnelly and the other authors found that 91% of IPOs eventually undercut their day one low, and 55% do it within 3 weeks. That's a great reason why the index weight exists and why you don't need to rush to buy these new listings. Now here's what to keep your eye on as these mega IPO stories evolve. Watch for developments on the NASDAQ proposal to shorten the time to index inclusion and anything similar from the S&P Index Committee, though it's unlikely those guys will budge. And then when these giants finally start trading, pay attention to the lockup expirations. When the early buyers are free to sell their shares, it's a potentially bearish event. And also keep an eye on the financials and the prospectuses and the earnings reports to keep track of when the AI giants might be eligible for the S&P. Remember, they need a year of continuous profits. And finally, watch for those announcements about getting added to the indexes, because stocks will often get a nice bounce when the press release drops, but by the time they are actually added to the index, a lot of times that bump fades. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, thank you, Jared. We're wrapping up today's market domination. Don't go anywhere. Amazon earnings are due after the closing bell. We've got the numbers and the analysis.